Hello. So in this video, we're going to have a look at Shopify and more specifically its valuation section on the Simply Wall Street company report. Now, the reason we're going to look into this is because like many other US listed stocks, it's earnings season right now. So they've just reported their latest quarterly results and full year results. And now while the company performed well in terms of its full year results, plenty of growth in many respects, it didn't provide the best guidance going forward. And there's a few reasons why that was, and I'll go into them in just a second. So the fact that it provided lower guidance, investors didn't really like that. And so even though the stock had already been sold off heaps like many other growth stocks since like October last year, since reporting its results, it got sold off another further like 20 odd percent. So it really has been declined quite a bit since its highs reached last year. So this article here from one of the analysts at Simply Wall Street goes into the latest results and then just talks a bit about the valuation. So that's why we're going to dive into it. So here we can see it provides a summary of all the results from the full year and basically how they performed. Plenty of growth in many areas, as we can see, like the gross merchandise volume increase, the revenue, and they perform pretty well. And then it goes into the valuation section. So while it looks like the company Shopify might actually be better value than it was in like the highs of last year, there's a few things to actually consider. So the net income that the company reported for the full year was actually quite heavily impacted by some investments it had in Affirm and Global E. Now, these investments have actually fallen quite a bit since the company reported its results, and that could obviously have an impact in the company's underlying net income going forward. So these were non-cash gains, and I'll show you what I mean by that. So if we go to the company's annual report that it just reported, we can see here on the income statement that the company has net unrealized gains on equity and other investments, which is where these things are considered, of $2.8 billion, right? And that is what has driven the net income up so much from like $327 million last year to $2.899 billion this year. Now that is obviously unrealized gains, so that they actually haven't sold in these reports, they haven't sold these investments, and that's basically what has driven the huge increase in the company's net income, because those stocks increased so much in that period. Now since the reporting date, as we mentioned, they have actually pulled back quite a bit. So if we were to look here at the Global E stock performance, the end of the year, or even basically here is Friday the 31st of December, $63. The stock is now trading at $34. So that net unrealized gain on that investment would be significantly lower than it was. Same thing if we were to look at Affirm, right, which is also the underlying investment it was talking about. And the analyst mentioned that the stock has declined even further since the end of the year. So 30th of December is $103, now it's $35. So those net unrealized gains, which we saw here, would actually be much lower if they're still holding onto these investments. So that is likely that the company will have a decline in net income. And now that kind of provides context as to why the company might be trading at a high multiple, and we'll get to that when we get to the company report. So just for some more context, on the company's annual report, you can see here in this notes to the financial statements, it actually gives us more context. So it tells us that the when the company Affirm went public, this is how like the valuation method was used, and when Global E went public on May 12th, this is how the valuation kind of was impacted. And so here you can see the net unrealized gains for the year with the 2.8 billion, and that's how the company's net income got impacted. So after having read through this article and looking at the company's annual report, this kind of provided me with some context as to how these graphs work, right? So you can see here that the company had significant, and these are obviously 12-month figures, trailing 12-month figures. And so for the company's revenue growth, it's obviously been pretty steady and growing pretty quickly. But for the net income, which is this teal blue line here, as we can see, it has grown significantly over the prior 12 months to the end of 2021. And then it's expected to decline quite significantly over the coming year. And now the reason being is obviously because these unrealized gains could have quite a big impact in these investments that they have. And also the company provided guidance saying, first of all, we're not going to experience as much growth as we did last year, because in the first half of 2021 it had like a significantly good period where there was like lockdowns, and like it just had a boost in its business. And also they've actually mentioned in their annual report that they're extending their favorable or more generous revenue sharing terms with their app and theme developers. And so this basically just means that they would be receiving less revenue from those kind of agreements, and that obviously can have an impact on their net income. So when we look at this article here, we can kind of get some context of why the net income might actually decrease. First of all, because it's not going to experience as much growth as it did in 2021 with regards to the COVID lockdowns and the benefit to e-commerce businesses. And secondly, due to those unrealized gains in those investments lowering quite a bit. So they're significantly lower than where they were at the end of the year. And so that's potentially why analysts are now forecasting for a lower net income over the coming year. And so on the valuation side of things, this actually provides us some context, right? So if we were to look at the current company's PE right now, this article actually tells us at the time of writing, it was about 28.5 times earnings. Now when you consider that for a company that's growing its revenue like 25 to 35% per year, that actually seems amazingly cheap. But all of a sudden, when we get some context of that is a 28 times PE multiple on this kind of net income, but net income is expected to decrease significantly, it all of a sudden becomes something more like a 215 times PE multiple if we were to use this net income down here. And even in some cases, though, it's actually expected to generate a loss by some analysts. So that gives us some idea that while the current valuation might look cheap, if you look at like the way net income is actually expected to trend over the next year, it actually could be way more expensive at something like 215 times earnings. So let's go have a look at this Simply Wall Street company report and just go through the valuation section. But first, before we get there, I just want to have a look at like the company overview before I get to the valuation section. So as we saw from the article, it seems to be like the valuation may not be the best, and this article goes in, this analysis will kind of support that. So having a quick look at the snowflake, we can see that the company doesn't seem to be the best value right now, only passing one of the 6 metrics, has pretty good future prospects, 2 of the 6 metrics are passed, has a really solid track record of performance, has really solid balance sheet health, 5 of the 6 metrics are passed, and obviously doesn't pass any checks because it doesn't pay a dividend. So in regards to the risks and rewards, it seems like there's quite a few risks actually here. So the earnings are forecast to decline by an average of 40% per year over the next 3 years. So this kind of supports what we were seeing here before, where the earnings are actually expected to decline. If you look over 3 years out, that actually is quite a significant decline. Next, it has a high level of non-cash earnings, and now that supports exactly what we just saw. That was like $2.8 billion worth of net unrealized gains, which is not a cash gain, right? It's an unrealized gain, and so that's a risk. And as we see, analysts don't expect that kind of non-cash expense to survive, and that's also why the company has like a free cash flow down here of so much less, because it's not that high. Now, if we look at the share price here, the next risk is that the company has a volatile share price, and over the past 3 months, it's been like trending downwards as we saw, and we will see in the share price performance chart. Next, it says there's been significant insider selling over the past 3 months. So this is kind of concerning, but we won't go into it in this video. But to get more context on that, what I would go and do is have a look at the management and ownership section just to see who's selling and how much they've been selling. Now, as for the rewards, though, we can see here that it says the PE ratio is below the IT industry average of 29 times earnings. So interesting, but again, we got some more context about the expected earnings growth, and that doesn't really provide me with much confidence because I know that the company's earnings are expected to decline. So consequently, that PE ratio will increase. So that's why I need to do a bit more digging on it. The next reward is that the company's revenue is expected to grow by 21% per year over the next couple of years. And that's pretty good revenue growth. And the final reward here is that the earnings growth was 812% over the past year. And as we saw, that was due to a high level of non-cash earnings. So while that's good on the surface, when I looked a bit deeper into it, I understood that it's actually like, okay, this maybe isn't sustainable, and it might just be like a one-off sort of game. So getting down here further, I won't go into the competitors, but to provide you with some more context, what I would look at here is the price history and performance. And as we can see, the stock, like many other growth stocks over the past couple of months, has been significantly sold off leading up to the start of 2022, and then even further. So it was back at like highs of $1,600 per share in November, but since then it's now reached $626. So it might seem like it's really good value right now, but we got to do some more research on like the expected future free cash flows and so kind of like what growth the company can have. So also to get some update, I would read through the recent news and updates just to try and see what kind of like the underlying business is doing, because it's all well and good for the stock price to decline heaps, but it's like unless there's like still a solid business underneath, the stock price might not actually be that appealing. Like if the business is deteriorating, then that could be why the stock price has declined. But in this case, it seems like there's some people who are writing some pieces on it, and they actually believe that like the company's still a very solid business, and it is a very solid business, but it might just be a case of when it was trading around here, investors' expectations for interest rates were very low, and they expected like sort of supportive economic policies from the Fed. Now it seems like that's obviously deteriorated as the inflation has grown and they expect higher discount rates, and also just the optimism back here was so high, right? Like it was kind of like priced to perfection maybe. So even though it was a great business, it was priced like it was going to have unlimited growth forever, and also perfect conditions and low interest rates, but it seems like it's been sold off since then because news has come out that that might not be the case. And so while it's still a high quality business, this might now provide like a better entry point for it. So that's what we're going to look into today. And so there's these bits of news here that provide me a bit of an update, and I would read through them just to see if like the underlying business is still solid. And so another thing that's worth touching on before we get to the valuation section is this fundamental summary. And now this gives us just a breakdown of the company's market cap, its revenue, and its earnings. And now if I was to look at this, like we said, the 27 times earnings, that's like really a comparative. If I look at a high growth stock and I see it has a PE ratio of 27, that's really appealing, right? But as we know, with valuations and especially PE, we can't look at the current price without considering the company's future growth prospects. And so now that we know from what we saw in that chart in the article, we know that net income is expected to decline significantly. And so this PE ratio, if we consider like next year's earnings that might are likely to be much lower, this PE ratio would actually be something like closer to 200. So this is just something to keep in mind. You can't look at these PE ratios just by themselves. We need to consider the company's expected earnings growth to get some more context on it. And so as for the earnings and revenue breakdown, this is for the prior 12 months and was last updated for the end of the year. And we can see here that on the revenue is generating, it has like earnings of $2.9 billion. And so it's in this unique case, its net profit margin is actually higher than its gross profit margin. Usually you see it as like a waterfall where the company has revenue, cost of revenue, gross profit, and then has to have some other expenses here, which is like its sales and marketing, general and admin, research and development, and then it has the leftover earnings. But in this case, because of the net unrealized gains from those investments, its net profit margin is actually higher than its gross profit. So a bit of a unique situation there. So let's get to the valuation section. And now here is the first thing I would look at. It is basically simply Wall Street's estimate of fair value based on a few assumptions and inputs. And so the assumptions and inputs are things like analyst estimates of the company's future free cash flows, and inputs and assumptions are also the company's discount, the discount rate we use in the model. So having a look at this, according to simply Wall Street's estimate, it estimates that the fair value is around $420 per share, and the current price is around $626. So for me, this tells me, okay, based on what analysts expect the company can generate in terms of free cash flow in the future, it could be overvalued. Now, to get even more context, I would have a look at this view data section here and see all the inputs and assumptions that are used in the model. I can see how many analysts are providing their estimates of like free cash flow. I can also see like the perpetual growth rate used and the discount rate. And as I've mentioned in previous videos, I may disagree with these, right? Like I may want a higher discount rate or a lower discount rate. If I was to use a discount rate of like 5% or 4%, then subsequently the valuation would actually increase and would be higher than 420, all else being equal. If I was to increase the discount rate, and I think, no, it needs to be like a 7%, 8%, 9%, because I think there's more risk involved and like the cost of equity is a bit higher because of certain assumptions in that, then the 420 would actually decrease, right? So if I used a higher discount rate, the valuation could go to 400, 350, and so on. And that seems to be why the stock has sold off so significantly, because people's discount rate that they're using in their free cash flow or discounted cash flow models has been increasing, right? So their future cash flows that the company is expected to generate aren't as valuable now because people are using a higher discount rate. And so those cash flows that are in the distant future aren't worth as much today because they're being discounted back at a higher discount rate. So having a look through all this, I would just basically try and get some context and see if I agree with the numbers. And also, in order to have some context about whether or not I actually agree with the numbers, I would need to go and do my own research, right? So I need to go and figure out what I think is an appropriate discount rate and what I think are appropriate numbers for the company's free cash flow growth. And I can't really make good assumptions on those figures unless I know the underlying business. So if I look at the company's, I need to look at the company's reports, what services they're offering and what kind of areas they're trying to expand into and what kind of growth they could experience. And then I can make an informed and educated decision on what the company's growth might be like. And then I can look at these and go, oh, no, I actually think the growth is going to be better than what these analysts expect. Or I can look at it and go, no, I actually think it's going to be lower than what they expect. And so the reason I say all that is just to kind of give you an idea of, you don't have to agree with these valuations, right? They're just an estimate of fair value, and they're definitely not a buy or sell recommendation. It's just to try and give you a context of how the company could be valued based on analyst expectations and certain other assumptions and inputs. So that's what I would do with this section, but it's still interesting to know that even based off analyst free cash flow estimates, this is what the estimate of fair value is from Simply Wall Street. And so the next section I want to touch on here is basically just what we talked about before. It's the price to earnings ratio. And so we saw a reward was that the company's PE ratio is actually cheaper than the US IT industry average of 29. And so if I was to look at that on the surface, again, I'm be like, oh, wow, that's really cheap considering how much I think the company's revenue is going to grow. But that's just revenue, right? Unless I look at the company's net income growth, I don't really have any context as to whether this is cheap or not. And so since I looked at this and I saw in the free cash flow, in the future growth section, I can see that this net income is just expected to decline actually to a loss, as we see here, of like $309 million. It's just expected to decline significantly. And so that would then lead the price to earnings ratio to grow significantly, in fact, even go negative, right? So this gives me some context of like, okay, it may be cheap right now, but that is because it has the one-off gain of those net unrealized gains in this report. And like if the Affirm stock and the Global E stock were to do incredibly well over the next 12 months, then that net income actually could be high again. But its cash earnings wouldn't be that high because it's a net unrealized gain. So I just wanted to go over all this and provide some context and basically give you some idea of like, okay, well, Shopify has declined heaps over the last couple of months, as we saw from the chart here. We've seen it decline significantly since its highs reached last year, but there's still some things to consider. And ultimately, like if I look at the long-term prospects of the business, that is what is going to inform my decision, right? So I need to now look into the business, the underlying business, and I can do that through reading these articles here and try and get an understanding of what the company's future growth prospects are like. And then once I've done all that, I can get some context about today's valuation, and I can then make an informed decision of, okay, I think today is a good entry price based on my assumptions being X, Y, and Z, like heaps of growth in this part of the business, improved margins because of this, and stuff like that. So I hope this video has provided some context on Shopify. And if you want to do any more research, the next sections I would look through is obviously the remaining parts of the company report, like the future growth, past performance, and also I'd have a look at these updates here just to see what's actually going on in the underlying business. So I hope this video has been helpful. Thank you so much for watching, and I'll see you next time.